Welcome, everyone, to the Daily Bread. I'm your host, Tom Hartman, and let's go over the market news for the day. Today was FOMC Minutes Day. We got the minutes that came in. That was pretty interesting. It's hard to decide if it moved markets because markets just absolutely ripped on equity side. As far as the Nasdaq is concerned and equities, it just kept moving up and to the right. Not everything in the markets moved up and to the right, but it was pretty significant. Now, even though those minutes came out later on in the day, there's reason to expect that we know what they were going to say, that that the Fed should ease. But let's go ahead and take a look at CNBC as they have a nice coverage about that.
Brian, thanks very much. After cutting interest rates by a quarter point for the first time in months, most Fed officials agreed it was appropriate to ease further beyond that cut that they gave. Some were a little bit more cautious, and we'll talk about that in a second with a big debate there. And those who were cautious citing financial conditions, which were pretty robust, and upside inflation risk remaining elevated. The Fed cut amid what the minutes called a shifting balance of risks at the time. Downside risk to employment had increased. Inflation risk had either diminished somewhat or had not increased. A few argued they could be either unchanged on rates or they could cut. They could go either way, essentially. They were concerned about the stalled inflation progress and inflation expectations. There was a range of views and apparently an interesting debate on just how restrictive the Federal Reserve was at the time or is even now. And that's reflected, I think, in markets. Participants stressed the need for a balanced approach in addressing the employment and inflation sides of the mandate.
It's important to remember here while we're listening to this that the Fed works on forward guidance, right? So more than just cutting rates, they work on making market participants believe a certain thing so they act in a certain way, or even if they don't necessarily believe it, that they'll act in a certain way. Powell's just been going out and flat out saying that now, month by month, as he's going on different interviews and making his statements at the presser. So over here, what we're seeing in the FOMC minutes, we have to assume that they're having these discussions within the room, knowing that this will come out later on, and it'll be another one of those drip-free things in order to manipulate the public. And so the idea here is that they can have the contentious debate, they could have the variant voices, they could have the different views, and at the very least make it seem like there's a big, healthy debate going on, and they're coming to firm conclusions, which is pretty interesting, in contrast with what we've been seeing at the pulpit, where Powell's basically saying, hey, we're in a situation where we haven't been here before. The employment market is weakening while inflation is still elevated. So let's take all this with a grain of salt.
Arguing that they would address that side of the mandate that was further from their goal. Stephen Myron, as you know, dissented. He had noted, as he has publicly since then, saying that the neutral rate has fallen. He thought the Fed was more restrictive because of that. Quick detail on the inflation bait. You had those saying, look, productivity is going to keep inflation down. You have lower net migration. That would put downward pressure on inflation. And employment was not a source of inflation. On the other hand, those who were more concerned about inflation talked about tariffs. They talked about inflation expectations remaining elevated and businesses saying that they would raise prices to pass along some of those tariff increases. Most thought the tariff effects would be realized, get this, by the end of next year, not this year, but the end of next year. And there was a line there, Brian, I thought was interesting. They are watching artificial intelligence, talking about the huge impact it's having on GDP and investment, and also noting the adoption has the potential to reduce employment. Brian?
All right. AI getting in there, reducing employment. That's a fancy way of saying people are going to lose their jobs. All right, let's move on. The next post here that I thought was worthwhile is this one from Marlin Capital, who was stating, we have just witnessed the largest retail investor buying ever. Retail has bought over $100 billion of U.S. stocks in the last month, the largest 1 month buying on record. That's SPY, Qs, Russell, NVIDIA, Tesla. So much liquidity coming into the markets. We'll touch on that in a little bit. All right, I thought this was interesting from Julian Brigden, who states here, in March, when we were recommended buying GDX gold miners ETF, one reason was the possibility of capital rotation from US tech. After a 75% rally, it has been a good trade. But big picture, I think we can go to 2011 levels. So the capital reallocation has barely started. Yeah, this has been the big thing, right? If you're into the gold trade, chances are you're paying attention to miners to see how they're actually moving, because often miners can be sort of a leverage play on spot on gold itself. And so, normally you like to see a strong correlation there. You want mine and Barrick Gold, some of these names, you want them to really go up, and you could buy the GDX as a basket of these. Now, if gold is headed, it's past 4,000 now. If we're going to be headed to 2011 levels on GDX, it can be a pretty significant run. This is one of those things I'd be looking for calls for. Maybe I don't want to own the stock outright, but calls on that, long dated calls for that for, let's say, the next year might be pretty sweet. All right, let's move on to the next one. This is a couple of clips from Top Traders Live, specifically the episode with Ken Carson, who's talking about market dynamics. Now, you're going to have to definitely go on to Spotify. That's why I listen to them and listen to the entire interview. Ken is always a wealth of information, especially about market participants and the option space. Certainly worth a listen. But let's take a look at a couple of clips here to see what he has to say about the end of the year and next year for markets.
The amount of chart inflows are bigger than ever. You put all this together, and then you have, again, historic liquidity at an administration who wants it higher. Do you want to be short this market? I mean, yes. Could we get a headline risk? And by the way, the reason institutions are underweight, reflexivity, again, let's go full circle, is because we're in a bubble. And the natural thought in the bubble is, I got to be underweight. This is crazy. This can't keep going on like this. Or I'll miss the upside because I don't want that left tail risk. Well, okay, but at some point you get pushed back in.
That's right.
And so reflexively, this setup is very bullish here as we enter the end of the year, and that goes till about the middle of January. After that January effect and Jan OPEX comes, the amount of chart inflows are bigger than that.
Let's force buyers there. Let's just take a look at another one of his clips before we move on.
I prefer to talk about the flows, and particularly here in this period as we enter October and start looking forward to the end of the year. I want to reiterate, again, it all goes full circle here. Structured product issuance is dramatically bigger than it was last year. Hedge fund long short equity is significantly bigger than it was last year. So it's not just seasonal, every year the XYZ happens. These effects are getting bigger. And this year we also have a now beginning and heading towards the takeover of the Fed, which is coming in May in full for next year. And markets already know it. So it's already kind of put in place there. So liquidity is coming. It's already on the way. And unlike, let's say, last year and most years, institutions are caught underweight. So you have a recipe here of supply and demand dynamics that are not in your favor. I prefer to.
I mean, that to me is so unbelievably bullish. And after seeing the move we're seeing in market, just all-time high after all-time high, it makes me really think, okay, we can't be missing this boat. Bitcoin is one of those things, like it hasn't moved up nearly as much as I would have expected to. And so there seems to be runway. Like if $250,000 Bitcoin is on the menu, like what are we doing? What are we doing? How do we don't own enough? Like, forget about what they're saying, what the maxis say about Bitcoin, which I think is perfectly valid. But you don't have to buy into that pitch. You just have to see what's going on with markets, with gold going up, equities going up, even the dollar's rallying some off of the lows here. But it's just it's so hard when you're seeing these high valuations to jump into it. But if we're gonna have these forced buyers into the markets, because the markets can only go up so much before you can just sit around going, hey, I think they're going to fall. At some point you have to say, look, I guess I got to buy high to sell higher. Very interesting. All right. A couple more posts here before we wrap it up. This one comes from Michael Green, Professor Plum 99 on X, who's responding to here. Duration risk is lowest in history. No shit, Sherlock. Maturity is shortest in history. The reason why high yield spreads are tight is because issuance has been low and funds in high yield must be reinvested in remaining bonds. Same thing happened pre-GFC. And there's a number of these signs that are popping up that we're seeing. You know, these references to .com, references to GFC, references to structural weakness within the financial markets. Where that shows up, when that actually pops in the markets and we see a big drop, who knows, and how big that drop can be and how long it can be. We don't know. But for the moment, we can expect all-time highs with the ice cracking underneath. And finally here, a post from Cross-Border Capital, Cross-Border Cap on X, who says, "Psst, let's not tell the economists. Liquidity suggests 2026 may be better than they think, but not so good for assets." Interesting, right? Business confidence might be high, but equity markets might take a beating. All right, that's it for the Daily Bread for today. Tune in tomorrow for even more threads. Thanks.